How are investment incomes like dividends and capital gains taxed? Imagine earning money not just from working but also from your investments. That extra income can come from dividends or selling investments at a profit. But how does the government treat that money? Let's break it down. Dividends are payments you get from owning shares in a company. There are two main types. The first is qualified dividends. These meet specific IRS rules and are taxed at lower rates, similar to long-term capital gains. For the year 2025, these rates are 0%, 15%, or 20%, depending on your total taxable income and filing status. For example, if you are single and have taxable income up to $48,350, you pay 0% on qualified dividends. If your income exceeds $533,400, the rate jumps to 20%. Married couples filing jointly have higher income thresholds, making it easier to pay the lower rates. The second type is non-qualified or ordinary dividends. These do not meet the IRS criteria for qualified dividends and are taxed at your regular income tax rates. These rates range from 10% to 37% in 2025. So, if you receive non-qualified dividends, expect them to be taxed at a higher rate than qualified dividends. Now let's talk about capital gains. This is the profit you make when you sell an investment for more than you paid. If you sell within 1 year of buying, it's called a short-term capital gain. These gains are taxed at your regular income tax rates, which can be as high as 37%. If you hold the investment for more than 1 year, it's a long-term capital gain. These are taxed at the lower rates of 0%, 15%, or 20%, depending on your taxable income and filing status. The reason for these lower rates on long-term gains and qualified dividends is to encourage people to invest and hold assets longer. It's a way the government promotes saving and investing for the future. For Asian American taxpayers, understanding these rules is important because investment income can add to your overall taxable income. Your filing status and total income determine which tax rates apply. For example, married couples filing jointly usually have higher income limits for paying lower rates on dividends and gains. If you have investments from both U.S. and foreign sources, you need to report all income correctly and consider any tax treaties or foreign tax credits that might reduce your tax bill. When you receive dividends, your brokerage will send you a Form 10999-DIV. This form reports your dividend income to both you and the IRS. For capital gains, you will report them on Schedule D and Form 8949 when you file your taxes. Keep in mind, if your investment income is high enough, you might owe an additional 3.8% tax called the net investment income tax. This applies to certain high-income taxpayers and can add to your overall tax. Thinking ahead, holding investments for more than 1 year can help you pay less in taxes because long-term capital gains are taxed at lower rates. Managing your income levels can also help you stay within lower tax brackets. In summary, dividends and capital gains are taxed differently based on their type and how long you hold your investments. Qualified dividends and long-term gains get the special lower rates, while non-qualified dividends and short-term gains are taxed at your regular income rates. Knowing these rules helps you plan better and keep more of your investment earnings.